Hi, I'm Sahil Kapoor. I look at investment products at 361 Wealth, and today I'm going to talk to you about fixed income in the new tax regime. The implementation of the new tax regime has ushered in several alterations affecting investments, especially fixed income. So before April 2023, most investors preferred debt mutual funds and market-linked debentures for the debt allocation, as they were taxed efficiently and yielded 7 to 8% post-tax returns. Post the changes, the same instrument will now yield 2 to 2.5% lower. So, what do you do now? You need to explore alternative avenues that compensate for the tax-adjusted returns. Let's try and understand these. Mutual fund and conventional debt, private credit, real assets, hybrid funds, exposure to offshore debt. Mutual fund and conventional debt will continue to play a very big role despite the lower post-tax yield. Why? For two main reasons. Firstly, high-quality debt is stable and offers counter-cyclical benefits, which means when equity markets go for a tumble, the debt in your portfolio saves you. Secondly, they are great tools for cash flow management as they provide regular income. When you buy a fixed income instrument directly, you pay tax as you receive the income, whereas in a mutual fund, you pay tax only when you redeem. This tax deferment can add up to 25 bips to your debt portfolio. Private credit is gaining popularity among most investors. Why? Because the post-tax alpha now over debt mutual funds and MLD has widened significantly. Given the strength in the economy, with relatively low level of corporate debt, a constantly improving debt resolution system makes private credit a very interesting asset class. But you must tread carefully, because lending to small mid-market companies or smaller subsidiaries of big corporates might encounter challenges in servicing their debt due to insufficient cash flows. You will need the guidance of a seasoned professional to navigate this tricky financial terrain. Another thing to keep in mind is how you will get the money back. Is it through operating cash flows, asset sale, or an IPO? It's also crucial to understand the value and enforceability of the collateral pledged against the debt. Next comes real assets like REITs and InvITs. They deliver regular income and come with tax advantages. They are simply like a mutual fund of income-generating assets, offering liquidity, professional management, and diversification. Investors should start by assessing the current yield on these assets, the rental or tariff growth, management quality, governance structures, and the asset value potential. Also, did you know that while there are thousands of these assets globally, in India, we only have a handful of listed REITs and InvITs, which means untapped potential and an opportunity to invest into AIFs which are investing in these income-generating assets, which they will eventually exit through an InvIT or a REIT. Now, let's cover hybrid funds. Hybrid funds are a tax-savvy choice. They are effectively taxed at around 10% if they allocate at least 35% of their assets to equities. There are many types of hybrid funds, but we prefer those which have higher allocation to counter-cyclical assets like debt and gold. We do not prefer hybrid funds which have higher allocations to equity and arbitrage, as these strategies can be accessed through other mutual funds in a tax-efficient manner. Now, let's come to offshore debt. Right now, interest rates in the US are nearly at a 15-year high. Investment-grade securities are offering dollar yields between 7 to 8%. The US economy is unlikely to sustain such high level of interest rates for long periods of time, given their growth, demographics, and high level of debt. So investors looking to build dollar assets should invest in offshore debt right away. As we know, debt plays a crucial role in your investment portfolio. To thrive in this ever-changing investment world, you need to fine-tune your debt strategy to maximize risk-adjusted returns. My advice is, whether you're exploring private credit, real assets, or hybrid funds, to increase the tax adjusted returns on your portfolio. Be cognizant of the additional risk you're adding to the portfolio and create a well diversified and balanced portfolio to manage that risk.